How did the ECB respond to the Eurozone debt crisis? Imagine a region where countries share a common currency but face different economic challenges. That's what happened during the Eurozone debt crisis. The European Central Bank had to act fast to keep the entire area afloat. Their first move was to cut interest rates, making borrowing cheaper for governments and banks. This helped them access funds more easily and prevented a credit crunch. Next, the ECB offered long-term refinancing operations. These are loans given to banks with favorable terms, giving them enough liquidity to keep lending. This was vital because banks needed to stay solvent and continue supporting businesses and consumers. The central bank also introduced unconventional measures. In 2012, they launched the Outright Monetary Transactions Program, which allowed them to buy government bonds of troubled countries in unlimited amounts. This reduced bond yields and eased the pressure on governments trying to manage their debts. The ECB became a lender of last resort for banks and a buyer of last resort for government bonds. This meant they provided essential liquidity to keep markets functioning smoothly. They also aimed to balance controlling inflation with supporting financial stability. This was tricky because too much support could encourage risky behavior, but withdrawing it too soon could cause a collapse. As the crisis continued, the ECB focused on reducing differences in borrowing costs between stronger and weaker countries. They targeted the spreads between core countries like Germany and peripheral countries like Greece or Spain. This helped level the playing field and gave weaker countries more room to manage their economies. Of course, not everyone agreed with these steps. Some northern countries criticized the low or negative interest rates because they hurt savers. Others in the periphery felt the measures were not enough. Still, the ECB's actions played a key role in preventing the Eurozone from breaking apart. They stabilized markets, lowered borrowing costs, and kept the euro intact during a very turbulent time. In the end, their combination of interest rate cuts, liquidity support, bond purchases, and innovative programs helped contain the crisis. These efforts reassured investors and kept the Eurozone's financial system from collapsing.